Welcome to our comprehensive tutorial on Chartist patterns, the essential knowledge for successful trading. In this video, we will explore and explain all the important Chartist patterns that every trader should know. Whether you're a beginner looking to enhance your trading skills or an experienced trader seeking to refine your strategies, this tutorial will equip you with the necessary tools to analyze price charts effectively and make informed trading decisions. Join us as we delve into a world of triangles, head and shoulders, double tops, and many more Chartist patterns that can significantly enhance your trading expertise. Get ready to unlock the secrets of successful trading with this ultimate guide to Chartist patterns. Let's start with the basics: supports and resistances. A support is a specific price level where buying demand is strong enough to prevent a decline in prices. It represents a price zone on a chart where there is a concentration of buyers, creating upward pressure and limiting the downward movement of prices. When the price of an asset approaches or reaches a support level, it is likely to bounce back upwards as traders view this level as an opportunity to buy. Support is often associated with significant demand zones or historically significant price levels. Traders use this information to define their buying strategies, determine stop-loss levels, and identify potential entry points in the market. It is important to note that supports do not always guarantee a trend reversal, but they provide valuable insight into price dynamics and assist traders in making informed decisions. A resistance is a specific price level where selling pressure is strong enough to prevent an asset's price from rising further. It represents a price zone on a chart where there is a concentration of sellers, creating a ceiling or barrier that hinders upward price movement. When the price of an asset approaches or reaches a resistance level, it is likely to encounter selling pressure and face difficulty in surpassing that level. Resistance levels are often formed at significant price levels or areas where there is a historical pattern of selling activity. Traders use these levels to determine potential exit points or areas where they may consider selling their positions. While a resistance level doesn't guarantee a reversal, it is an important factor to consider in analyzing price trends and making trading decisions. A range refers to a price level where an asset is trading within a specific period of time. This period could be a day, a week, a month, or even longer. A range is formed when an asset's price bounces back and forth between a specific price level known as the support level and a higher price level known as the resistance level. Traders use ranges to identify potential trading opportunities. When an asset's price is trading near the support level, it is considered oversold and may be a good time to buy. Conversely, when an asset's price is trading near the resistance level, it is considered overbought and may be a good time to sell. Ranges can also be used to identify breakout opportunities. A breakout occurs when an asset's price moves outside of the support or resistance level, indicating a potential change in trend. Traders can use this breakout as an opportunity to enter or exit a position. We will learn more about breakouts in a few seconds. Ranges can take on different shapes and sizes, ranging from narrow sideways trading to wide, choppy price movements. Common range patterns include rectangles, channels, and flags. They will be seen later. In a range, traders look for a price range where the price of an asset has been trading within a defined range over a period of time. To enter a long trade, traders wait for the price to approach the support level of the range and then buy when the price begins to move higher. The target price for the trade is typically set at the resistance level of the range, where the price has previously failed to move higher. Traders should also set a stop loss below the support level to limit their losses if the price moves against them. In summary, for a long trade in a range, the entry point is near the support level, the target price is near the resistance level, and the stop loss is placed below the support level. Ranges play an important role in technical analysis and can provide valuable insights for traders. By identifying key support and resistance levels, traders can make informed trading decisions and potentially profit from price movements within a range or a breakout. A breakout in technical analysis refers to the price movement of an asset breaking through a significant level of support or resistance. It indicates a shift in the balance between buying and selling pressure, often leading to a continuation of the existing trend or the start of a new one. In the case of a bullish breakout of a resistance level, it means that the price has surpassed a key level that was previously preventing upward movement. This breakout suggests that buying pressure has overwhelmed selling pressure, indicating a potential shift in market sentiment. Traders often interpret this as a signal to enter long positions, expecting the price to continue rising. Following a bullish breakout, a pullback may occur. A pullback is a temporary reversal in price after a breakout, where the price retraces back to test the broken resistance level, which now acts as a support. This pullback provides an opportunity for traders who missed the initial breakout to enter positions at more favorable prices. It is essential to assess the strength of the pullback and ensure that it remains within acceptable parameters. Conversely, a bearish breakout of a support level occurs when the price falls below a significant level that was previously providing buying support. This breakout suggests that selling pressure has intensified, potentially leading to further downward movement. Traders may interpret this as a signal to enter short positions, expecting the price to continue declining. After a bearish breakout, a pullback may occur as well. In this case, the price retraces back to test the broken support level, which now acts as a resistance. Traders may use this pullback as an opportunity to enter short positions or manage existing ones. It's important to note that breakouts and pullbacks are not guaranteed to result in sustained price movements, and proper risk management techniques, such as stop-loss orders, should be implemented to manage potential risks. Bullish channel. A bullish channel is a price pattern where an asset's price is trending upwards within a defined channel. The channel is formed by drawing a trend line connecting the higher swing lows and another trend line connecting the higher swing highs. A bullish channel indicates a strong uptrend in the asset's price. As long as the price stays within the channel, traders will look for opportunities to buy the asset when it approaches the lower trend line or support level. This is because buying at these levels provides a relatively low risk entry point into the market with a potentially high reward as the price continues to rise within the channel. In addition to providing entry points, a bullish channel can also be used to set profit targets. Traders may look to sell the asset when it reaches the upper trend line or resistance level. This is because the price may struggle to break through this level, making it a potential area of profit taking for traders. Please note that while a bullish channel indicates a strong uptrend, it does not guarantee that the price will continue to rise. Traders must still practice proper risk management and be prepared for the possibility of a trend reversal. To enter a long trade, traders wait for the price to approach the support level of the channel and then buy when the price begins to move higher. The target price for the trade is typically set at the resistance level of the channel, where the price has previously failed to move higher. Traders should also set a stop loss below the support level to limit their losses if the price moves against them. Now, conversely, a bearish channel is a price pattern where an asset's price is trending downwards within a defined channel. The channel is formed by drawing a trend line connecting the lower swing highs and another trend line connecting the lower swing lows. A bearish channel indicates a strong downtrend in the asset's price. As long as the price stays within the channel, traders will look for opportunities to sell the asset when it approaches the upper trend line or resistance level. This is because selling at these levels provides a relatively low risk entry point into the market, and with a potentially high reward as the price continues to fall within the channel. In addition to providing entry points, a bearish channel can also be used to set profit targets. Traders may look to buy the asset when it reaches the lower trend line or support level. The price may struggle to break through this level, making it a potential area of profit taking for traders. Now, note that while a bearish channel indicates a strong downtrend, it does not guarantee that the price will continue to fall. Traders must still practice proper risk management and be prepared for the possibility of a trend reversal. To enter a short trade, traders should wait for the price to approach the resistance level of the channel and then sell when the price begins to move lower. The target price for the trade is typically set at the support level of the channel, where the price has previously failed to move higher. Traders should also set a stop loss above the resistance level to limit their losses if the price moves against them. But, what defines a bullish or a bearish trend? Let's talk about a very important rule in chartism. I call it the rule of Dow's waves. It comes from the Dow theory. But in fact, this theory is much more elaborate. In any case, let's begin. So, a bullish trend is characterized by a series of higher highs and higher lows in an asset's price. This means that each successive high and low is higher than the previous one, indicating a strong uptrend in the asset's price. A bullish trend typically indicates positive market sentiment, with buyers being more active than sellers. Traders will look for opportunities to buy the asset during pullbacks or retracements within the trend, in anticipation of further price increases. On the other hand, a bearish trend is characterized by a series of lower highs and lower lows in an asset's price. Which means that each successive high and low is lower than the previous one, indicating a strong downtrend in the asset's price. A bearish trend typically indicates negative market sentiment, with sellers being more active than buyers. Traders will look for opportunities to sell the asset during bounces or rallies within the trend, in anticipation of further price decreases. In uptrends, the lows can be used as a stop-loss level, whereas the highs can be used as entry points. In a bearish trend, inverse the roles. Both bullish and bearish trends can be identified using technical analysis tools such as trend lines and moving averages. Now comes a very, very important pattern, maybe the most important. The 1-2-3 pattern. The 1-2-3 pattern is a popular chart pattern in technical analysis that is used to identify potential trend reversals or continuation. In a bullish 1-2-3 pattern, the first point, or 1, is a swing low point in the price of the asset. Point 2 is the next swing high. And point 3 is the following swing low. The uptrend will be validated if the price breaks above point 2 level. In a bearish 1-2-3 pattern, the first point, or 1, is a high. The 2 is a low, and the 3 is a high. The downtrend will be validated if the price breaks below point 2 level. Here, the green points form a non-validated bullish pattern, whereas the red and black ones form valid ones. So, in a downtrend, a bullish 1-2-3 pattern signals a reversal, then continuation of the trend. In a bullish to bearish reversal, we see the bearish pattern form instead. Now, before we move on to other patterns, do you remember the breaks out of a range? Let's see, the box, or rectangle pattern. Here, the range is called a box, or a rectangle. In a bullish box, prices enter from below, and the breakout occurs above the box. It's a continuation pattern. Similarly, a bearish box, or rectangle, is a bearish continuation pattern. Reversal patterns, tops and bottoms. Now, we move on to reversal patterns based on tops and bottoms. Let's begin with a simple one. V-bottom and V-top. The V-bottom pattern is a bullish reversal chart pattern that is formed when the price of an asset makes a sharp and sudden downward movement, then forms a V shape, and finally starts to move upwards again. This pattern indicates that the sellers were in control at the beginning, but the buyers were able to take over and push the price higher. To enter a long position based on the V-bottom pattern, traders should wait for the price to break above the resistance level that is formed by the high point of the V shape. Or, if there is a pullback, above the high of the pullback. The target price can be set at the level of the previous high, while the stop loss should be placed just below the low point of the V shape or the pullback. Conversely, the V-top pattern is a bearish reversal pattern that is formed by a sharp rise followed by a sharp decline. It looks like an inverted letter V on a chart. These patterns are difficult to trade because everything happens too fast. You can use smart money concept and liquidity study to enter a trade on this pattern. W-bottom and M-top. After tops and bottoms with only one peak or valley, we have double ones. The generic form is a W for the bottoms. And a M is the generic form for the tops. A W-bottom is a reversal from a bearish trend to a bullish one. A lot of patterns are derived from it. Most reversals occur with this pattern or a variant. AM top changes the trend from bullish to bearish. Let's start with the straight double bottom. The double bottom pattern is a bullish reversal pattern. It occurs when the price creates two distinct lows at approximately the same level, separated by a peak in between. To enter a long trade using the double bottom pattern, traders should wait for the formation of the second bottom and then buy when the price breaks above the peak that separates the two bottoms. The target price for the trade can be set by measuring the distance from the peak to the lowest point of the pattern and projecting that distance above the peak that separates the two bottoms. The stop loss can be placed below the lowest point of the pattern. The double top pattern is a bearish reversal pattern that occurs after an uptrend. It is formed when the price of an asset reaches a high level, pulls back, and then rises to the same level again, forming a top. This level, known as the resistance level, is a key price point that traders watch closely. To trade the double top pattern, traders look for a break below the support level, which is the low point between the two tops. This break confirms that the pattern has formed and that the price is likely to reverse to a downtrend. Traders can enter a short position at this point and set their stop loss above the resistance level to limit their losses if the price reverses again. The target price is often set based on the distance between the resistance level and the support level. Traders can calculate this distance and project it downward from the support level to identify potential price targets. We also have variants of these patterns. More generally called W or M patterns, they differ in the level of the swing highs or lows. You'll find two variants of W bottoms. They differ by a first swing low lower or higher than the second. As for the M-top pattern, they differ by the level of the swing highs. Gladly, thanks to only two parts, there are few variants. But, can we have more than two parts? Yes. Triple bottom and triple top. The triple bottom pattern is a bullish reversal pattern. It occurs when the price of an asset makes 3 attempts to break through a support level, but fails to do so each time. This pattern is formed when the price reaches the same level 3 times and is unable to go lower, indicating that the sellers are losing momentum and the bulls are taking over. To enter a long position using the triple bottom pattern, traders should wait for the price to break above the resistance level that connects the two peaks. The stop loss can be placed below the lowest trough of the pattern. The target price can be determined by measuring the distance from the bottom of the pattern to the resistance level and projecting that distance upward from the breakout point. Now you know that there is a triple top. A triple top pattern is a bearish reversal pattern. It occurs when the price of an asset makes 3 attempts to break through a resistance level, but fails to do so each time. This pattern is formed when the price reaches the same level 3 times and is unable to go higher, indicating that the buyers are losing momentum and the bears are taking over. To enter a short position using the triple top pattern, traders should wait for the price to break below the support level that connects the two troughs. The stop loss can be placed above the highest peak of the pattern. The target price can be determined by measuring the distance from the top of the pattern to the support level and projecting that distance downward from the breakout point. There are also variants to these patterns. Due to the fact that they contain 3 parts, there are a lot more possibilities. Let's talk about the best known of all. We will move to other variants later. Head and shoulders. The bearish head and shoulders pattern is a chart pattern that indicates a possible trend reversal from an uptrend to a downtrend. It consists of 3 peaks with the middle peak, the head, being the highest and the other 2 peaks, the shoulders, being slightly lower in height. The neckline is the line drawn by connecting the low points between the peaks. When the price breaks below the neckline, it confirms the pattern. For a short trade, the entry should be below the neckline after the confirmation of the pattern. The target price can be set by measuring the distance from the top of the head to the neckline and subtracting it from the neckline. The stop loss should be placed above the right shoulder. The inverted head and shoulders pattern is a reversal pattern that typically forms after an extended downtrend. It consists of 3 valleys with the middle one, the head, being the deepest, and the 2 others, the shoulders, being smaller and roughly equal in height. The pattern is completed when the price breaks above the resistance level formed by the neckline, which is drawn connecting the highs of the two valleys that form the shoulders. To enter a long trade, traders typically wait for the price to break above the neckline with a strong volume. The stop loss can be placed below the right shoulder, while the profit target can be set at a distance equal to the height of the pattern, measured from the neckline to the top of the head. For example, if the distance between the neckline and the top of the head is 100 pips, the profit target should be set at 100 pips above the neckline. Please note that the neckline can be slanted. Here is an example for the head and shoulder. Here is another for the inverted form. Now, what happens when you have more than 3 peaks? All sort of things can happen. We'll see further with diamond and wedge patterns, some sorts of variance. But let's end this top and bottom part with a very smooth change in trend. First, the saucer, or rounding. The rounding pattern, also known as the saucer pattern, is a long-term reversal pattern. It indicates a shift from a downtrend to an uptrend. It is characterized by a gradual and rounded bottom formation that resembles a bowl or a saucer. The pattern is formed by a gradual decline in price followed by a flattening out, creating the saucer shape. The key characteristic of this pattern is a gradual and steady increase in price that eventually breaks out above the saucer's rim. This signifies the start of a new uptrend. For traders looking to enter a long position based on the rounding pattern, the entry point should be just above the rim of the saucer. The target price can be set at a level that corresponds to the pattern's height, measured from the bottom of the saucer to the rim. The stop loss should be placed just below the saucer's bottom. This pattern takes its time. It is very easy for the trader. The opposite of this pattern is the rounding top. The rounding top pattern is a bearish reversal pattern that occurs at the end of an uptrend. It is formed when the price of an asset moves upward for an extended period of time, and then starts to move in a horizontal direction, forming a rounded top shape. This pattern signals that the buyers are losing momentum and the sellers may take over the market soon. To trade the rounding top pattern, a trader can enter a short position once the price breaks below the support level of the pattern. The target price can be set at the distance between the highest point of the pattern and the support level. As for the stop loss, it can be placed slightly above the resistance level of the pattern. Here is a variant. The cup and handle. I categorize this pattern as a bottom and reversal pattern, but it can also be a continuation pattern. The cup and handle pattern is a bullish pattern that is formed when the price of an asset reaches a peak, the lip of the cup, and then pulls back, forming a rounded bottom, the cup. After forming the cup, the price will often consolidate briefly, the handle, before resuming its upward trend. Traders who spot a cup and handle pattern may consider entering a long position once the price breaks above the handle. The target price for the trade is often set to be the distance from the bottom of the cup to the lip, projected upward from the point of the breakout. Stop loss orders are typically placed just below the bottom of the handle. The inverted cup and handle pattern is a bearish reversal pattern that is the opposite of the cup and handle pattern. It is characterized by a downward price movement that forms an inverted U shape, followed by a consolidation period where the price forms a handle. The entry point for a short trade would be at the breakout of the pattern's lower trend line, which confirms the bearish sentiment. The stop loss should be placed above the handle, while the target price could be set to the height of the pattern subtracted from the breakout point. For example, if the pattern's height is $10 and the breakout point is at $8, the target price would be set at $6. We are done with basic bottoms and tops. We will find other ones. But I'd like to introduce a new basic structure for our patterns. The triangles. Let's begin with a variant of triple tops. The rising wedge. The rising wedge is a bearish reversal chart pattern that forms when the price is making higher highs and higher lows, but the range between the high and low prices is decreasing. It looks like a triangle that is slanted upwards. The rising wedge pattern is often seen as a sign of weakness in the market, indicating that a reversal may be imminent. For a short trade, the entry point is when the price breaks below the lower trend line of the wedge. The stop loss should be placed just above the upper trend line. The target price is typically set at the distance from the entry point to the height of the pattern. The falling wedge. The falling wedge pattern signals a potential bullish reversal. It is formed by two descending trend lines, one for the highs and one for the lows, that converge towards each other. This indicates that the price is making lower lows but also higher lows, showing that the selling pressure is decreasing and buying pressure may be increasing. For a long position, the entry point is usually above the upper trend line of the pattern, once the price breaks out of the wedge formation. The stop loss should be placed below the lower trend line, as a break below this level may invalidate the pattern. The target price can be set by measuring the height of the pattern from the highest point to the lowest point, and adding that distance to the breakout point. Bullish wedge. The bullish wedge pattern is a continuation pattern in a bullish trend. It is characterized by a narrowing price range between two trend lines that slope downwards. The lower trend line connects the price lows while the upper trend line connects the price highs. Traders can enter a long position when the price breaks out above the upper trend line with a stop loss placed below the lower trend line. The profit target can be set to the height of the wedge pattern. Bearish wedge. The bearish wedge pattern is a bearish continuation pattern. It results in a downward movement in price after a period of consolidation. The pattern is formed by two converging trend lines, with the lower trend line being steeper than the upper trend line. The entry point for a bearish wedge pattern is typically on a break below the lower trend line, with a stop loss placed above the upper trend line. The target price for the trade is typically equal to the height of the wedge pattern, measured from the highest point of the pattern to the lowest point, and projected downward from the breakout point. Bullish flag. The bullish flag pattern is a continuation chart pattern that occurs during an uptrend. It is formed by a sharp upward price movement, followed by a consolidation period, which resembles a flag or a pennant. The flagpole is the initial sharp move up, while the flag is the consolidation period that follows. When the price breaks out of the flag to the upside, it indicates a continuation of the uptrend. For a long trade entry, the trader should wait for a breakout above the upper resistance line of the flag. The target price can be set at a distance equal to the length of the flagpole, projected from the breakout point. The stop loss can be set below the lower support line of the flag. Bearish flag. The bearish flag pattern is a continuation chart pattern that typically occurs in a downtrend. It consists of a downward price move, flagpole, followed by a consolidation period, flag, that is characterized by higher highs and higher lows. This pattern indicates that the bears are taking a break before pushing the price lower again. To enter a trade using the bearish flag pattern, traders typically wait for the price to break below the lower trend line of the flag, confirming the continuation of the downtrend. The target price is usually set to the same distance as the flagpole, projected downward from the point of the breakout. A stop loss can be placed above the highest point of the flag to limit potential losses in case the pattern fails. Ascending triangle. An ascending triangle is a bullish chart pattern that forms when the price is making higher lows while the resistance level remains flat. This pattern indicates that the buyers are becoming more aggressive and the sellers are losing control. To enter a long trade using an ascending triangle pattern, wait for the price to break above the resistance level with a strong volume. The entry point is at the breakout level or slightly above it. The stop loss can be placed below the recent swing low. To determine the target price, measure the distance between the highest and lowest points of the triangle and add it to the breakout level. Descending triangle. The descending triangle pattern is a bearish pattern. It is formed by a horizontal support line and a descending trend line that creates a triangle shape. This pattern typically indicates that sellers are in control and the price is likely to continue to decline. The entry point for a short trade is when the price breaks through the horizontal support line, which is the bottom of the triangle. The target price for this trade is usually set at a distance equal to the height of the triangle, measured from the highest point to the horizontal support line. The stop loss should be set just above the horizontal support line to limit potential losses if the price suddenly moves upwards. Reversal ascending triangle. The reversal ascending triangle pattern is a reversal pattern that signals a potential downward trend. It is formed by a horizontal support line and a trend line that converges with lower highs. As the price approaches the apex of the triangle, the selling pressure increases and eventually overcomes buying pressure, resulting in a breakdown of the support level. For a short trade, the entry point would be below the support level. After the breakout, the stop loss would be placed just above the resistance level, while the target price can be calculated by measuring the height of the pattern at its widest point and subtracting it from the breakout point. Reversal descending triangle. The opposite pattern indicates a bullish trend reversal. It is formed when the price of an asset is in a downtrend and reaches a support level, creating a horizontal line. The asset then experiences a period of consolidation and forms a descending trend line, which acts as resistance. The price of the asset breaks through the resistance line, indicating a potential reversal of the downtrend. Traders can enter a long position when the price breaks through the resistance line, with the entry point being slightly above the breakout point. The target price can be set to the height of the triangle pattern, measured from the breakout point to the horizontal line of support. Stop loss can be set just below the support level to limit potential losses if the price falls back into the triangle pattern. Symmetrical triangle. The symmetrical triangle is a chart pattern that occurs when the price is consolidating and forming a triangle shape with two converging trend lines. This pattern can signal a continuation of the current trend or a reversal, depending on the direction of the breakout. In the case of a breakup, the entry point for a long trade is above the upper trend line, once the price has broken out of the triangle. The stop loss should be placed below the support trend line. The target price can be calculated by measuring the height of the triangle and projecting it upwards from the breakout point. Conversely, in the case of a breakdown, the entry point for a short trade is below the lower trend line, once the price has broken out of the triangle pattern. The stop loss should be placed above the resistance trendline. The target price can be calculated by measuring the height of the triangle and projecting it downwards from the breakout point. The price can also enter from above. And the break can be upside or downside. Bullish pennant. The bullish pennant pattern is a continuation pattern that forms after a strong uptrend. It consists of a flagpole, a consolidation period in the form of a small symmetrical triangle, and then a resumption of the uptrend. This pattern indicates that the market is taking a pause before continuing to move higher. To enter a long trade on the bullish pennant pattern, traders typically wait for a breakout above the upper trend line of the small symmetrical triangle. The stop loss can be placed just below the lower trend line of the triangle. The target price is often set by measuring the height of the flagpole and adding it to the breakout point. Bearish pennant. The bearish pennant is a continuation chart pattern that occurs during a downtrend. It is formed when the price consolidates into a small symmetrical triangle after a sharp price decline. The pattern gets its name from the shape of a pennant. When the price breaks out of the triangle, it is likely to continue the previous downtrend. To trade the bearish pennant, traders can wait for a breakdown below the support level of the triangle pattern. The entry point is usually below the support level, and the stop loss should be placed above the resistance. The target price can be calculated by measuring the height of the pennant's mass, the distance from the highest point to the base of the flag, and projecting that distance downwards from the breakout point. Broadening triangle, megaphone. The broadening triangle can be both a continuation and a reversal pattern, depending on its context. It is also called megaphone, mainly when it is a bullish continuation pattern. It is formed by two diverging trend lines with prices reaching higher highs and lower lows, with the range of prices widening over time. It creates a broadening pattern that resembles a megaphone, hence its name. This pattern can be both bullish and bearish, depending on the direction of the trend prior to its formation. The megaphone pattern can indicate a lack of consensus among traders, resulting in price volatility and uncertainty about the market's direction. It can also indicate a change in trend, with prices moving in an upward or downward direction. As a continuation pattern, the broadening triangle typically signals increased volatility and uncertainty in the market. It may indicate a struggle between buyers and sellers, with neither side able to gain control. Traders can look for an entry point when the price breaks out of the pattern in the direction of the prevailing trend. The stop loss can be placed just below the last swing low, while the target price can be set at the pattern height. Here is the bearish form. This is the opposite. When the broadening triangle appears as a reversal pattern, it can signal that the trend is about to change direction. In this case, traders can look for an entry point when the price breaks out of the pattern in the opposite direction of the prevailing trend. The stop loss can be placed just above the last swing high, while the target price can be set at the pattern height. Finally, the broadening triangle bottom is just the opposite, as a bullish reversal pattern. Broadening wedge. The broadening wedge pattern, also known as the expanding wedge, is a chart pattern characterized by price movement that forms two diverging trend lines that widen as the price progresses. This pattern can occur both in bullish and bearish markets and signals a period of increased volatility and uncertainty. In a bullish broadening wedge, the upper trend line represents the resistance level, while the lower trend line represents the support level. As the price bounces between the two trend lines, traders can look for entry points near the support level and set a stop-loss order below the trend line. The target price can be set at the top of the wedge plus the height of the pattern. In a bearish broadening wedge, the lower trend line represents the support level, while the upper trend line represents the resistance level. Traders can look for entry points near the resistance level and set a stop-loss order above the trend line. The target price can be set at the bottom of the wedge minus the height of the pattern. Diamond top. Now, let's combine triangle and broadening triangle. The diamond top pattern is a bearish chart pattern that can occur during an uptrend. It is formed by a series of higher highs and lower lows that create a diamond shape on the chart. The pattern is completed when price breaks below the lower trend line of the diamond. To trade the diamond top pattern, traders can look for an entry point below the lower trend line of the diamond. The stop loss can be placed above the upper trend line of the diamond. The target price can be set based on the size of the pattern, typically by measuring the distance from the highest point of the diamond to the lowest point and projecting that distance down from the breakout point. Diamond bottom. The diamond bottom pattern is a chart pattern that signals a potential bullish reversal. The pattern forms when the price action initially declines, then forms a symmetrical diamond shape and subsequently breaks out to the upside. Traders can enter a long position when the price breaks out of the diamond shape and closes above the resistance level. The stop loss should be set just below the support level of the pattern. The target price can be set based on the distance between the support and resistance levels of the diamond pattern. Flat base. The flat base pattern is a chart pattern that occurs when a stock or other financial instrument has been trading in a relatively narrow range for an extended period of time. During this period, the price remains flat and consolidates, forming a horizontal support level and resistance level. When the price breaks out of this range, it can be a signal for a potential uptrend. For a long trade, the entry point should be just above the resistance level of the flat base. The target price should be set at a distance equal to the height of the pattern added to the breakout point. The stop loss should be set just below the support level of the flat base. For a short trade, the entry point should be just below the support level of the flat base. The target price should be set at a distance equal to the height of the pattern subtracted from the breakdown point. The stop loss should be set just above the resistance level of the flat base. This was our last pattern. We've come to the end of this catalog of Chartist patterns. You may find variations and, depending on the author, differences. But now you know everything you need to know about patterns. Thanks for watching.